Hello, and welcome to our webcast. I'm Amy Pendergrass with Moss Adams, and I'm going to get us started for today's session. File your private foundations Form 990 PF with confidence. We're pleased that you've joined us today, and before we begin, I'm going to play our housekeeping video.
Welcome, and thanks for joining. We're pleased to present our continuing professional education webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. Today's session offers 1 CPE credit. To receive credit, you must meet the National Association of State Boards of Accountancy requirements. You must attend at least 50 minutes of the session and respond to at least 75% of polling questions. To participate in the polls, please check the button next to your answer within the slide window and click Submit. We'll track your progress and alert you when you've earned CPE credit. You can then click the certificate icon in the CPE Progress widget and download your CPE certificate. Don't worry if you can't download your CPE certificate today. We'll email you a copy in 2 weeks. If attending this webcast in a group, you must complete our Group CPE attendance sheet, available in our Slide Deck and Handouts widget to receive credit. Please have all group members sign it and send only 1 sheet per group. CPE credit can only be awarded to participants registered as themselves and isn't available for participants who view the on-demand version. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to introduce today's presenters from Moss Adams. We have Emina Cresswell, Senior Manager, Colleen Ramires, Senior Manager, Jennifer Teicheira, Senior Consultant, and Mike Anderson, Senior Consultant. Their bios and contact information can be found in your webcast console for your convenience. And now I would like to turn the floor over to Emina to get the presentation started.
Great. Thank you, Amy. Today we'll cover the Form 990 PF, highlights and pitfalls, talk briefly about excise taxes, some quick tax updates, streamlining your accounting and reporting structure, and if we have some time, some Q&A and some other housekeeping items towards the end. With that, we'll kick it off with the Form 990 PF. So part 1, the heading of the Form 990 PF, really has just a few items that we'd like to highlight. Item J is the accounting method. So an organization can either be a cash or accrual basis or other, although I'd say I haven't seen that one very often. Line 2 is just the checkbox to indicate whether required Schedule B is attached or not. So Schedule B is where the donor information is presented if they meet the filing requirement for the year. Column B is net investment income, so only investment information is provided in that column. Column C is adjusted net income, and this column typically is used for a private operating foundation. And then column D is disbursements for charitable purposes, but do note that this does have to be on cash basis, even though the organization might be completing its column A as accrual basis. And then just a few highlights that if you do have employees as a foundation, you would have pension plan and employee benefits in line 15. And then line 16 has a bit more detail with regards to legal fees, accounting fees, and other professional services. With that, we'll dive deeper into part 2, which is the balance sheet. The IRS really does focus quite a bit on investments. As you can see here, we've kind of highlighted a few areas. They really would like to know what type of investments an organization has, such as U.S. State government obligations, corporate stock, corporate bonds, fixed assets, mortgage loans, and other types of investments. Part 3 is usually seen if the organization has, for example, a accrual basis accounting and their book values are based on fair market value. So you might see unrealized gains and losses on the other increases or decreases or any sort of book to tax adjustment. With that, we are off to our first polling question. Amy?
All right, thank you. So the first question is, what type or size private foundation or other organization are you? And your options are private foundation, no alternative investment, private foundation, alternative investment, private operating foundation, or other. And we will give you a few moments to respond. To respond, you're going to click the button next to the answer you choose and hit submit. And then if you can't see that submit button, you're just going to enlarge the slide area. Looks like most have responded. We'll do another 5 seconds. All right, here you go.
Great. So it looks like a good mix of different types of entities, and other with being the majority. So that's great. So thank you for that. All right, let's dig some deeper. Part 4, some more numerical stuff, the capital gains and losses for tax and investment income. This is really where you describe the kind of property that was disposed during the year. Do note there are some exceptions to which columns need to be filled out based upon the asset that was disposed. So there are some exceptions where you may not necessarily have to fill out all of these columns. And then part 5, which is what a lot of organizations might be interested in, is what's my excise tax, and a quick summary of payments that were made during the year to determine are you overpaid or do you have taxes owed for the total tax year. So small little blurb, but that's really where a lot of organizations look for. With that, we're going to dive into kind of more of the yes/no's of the Form 990-PF, along with additional statements that may be required. So part 6 is really questions related to an organization's activities. And to just highlight a few of these in particular, such as line 3, has the foundation made any changes not previously reported to the IRS to its governing documents? The IRS requires that you do notify them of those changes and attach a conformed copy. And everyone is like, what's a conformed copy? It's really just a copy of, let's say you amended your bylaws, that you attach a complete copy of those bylaws in the same format as they were in the past. And they do need to be a signed copy, or if a signed copy is not available, a signed declaration instead, indicating that it's been adopted and approved. Some other parts and activities, statements regarding activities, is this one with regards to, are the requirements of Section 508E satisfied either through language in a governing instrument or by state legislation that effectively amends the governing instruments here. And of course, the IRS likes to talk in IRS code. So what does 508 really mean? Well, it's really just to, discussions about did the organization make its 5% minimum distribution requirement, and also prohibits the foundation from engaging in acts of self-dealing, such as, we'll cover that a little bit more in more detail in a bit, and then refrains from excess business holdings, making jeopardizing investments, and making taxable expenditures. And we'll cover taxable expenditures as well in a little bit more detail later on. And then one of the other questions on this part is to enter the states to which the foundation reports with or is registered with, and whether they provide a copy of their Form 990-P to the Attorney General or a designee. So this is where you would indicate the state that the organization is registered in. And sometimes a no answer is fine, as some Attorney General or designees don't require copies of 990-PF. So just make sure to attach an explanation if there is a no answer to this particular question. right, just a few more questions. This particular question, question 11, really asks about whether the organization holds directly or indirectly a controlled entity under the section of 512B13, which really just means is it more than 50% ownership? Then that includes constructive ownership as well. If there is, the IRS requires that the organization attach a detailed schedule listing the organization's name, address, etc., and also any kind of transactions that occur between the two or more organizations. And then question 12, did the foundation make a distribution to a donor advised fund over which the foundation or a disqualified person had advisory privileges? If yes, attach a statement. I'm highlighting this one because this is a bit in the news lately, and Congress has enacted some legislation that's been kind of been mulled over for a few years now. So the donor advised fund section has been in the news a lot, and we'll cover that in a little bit as to what Congress has in mind right now and the Green Book that has just been issued as to what the focus is from current Congress. So we'll cover that in a little bit more detail. And then the last question on this one, did the foundation comply with the public inspection requirements for its annual returns and exemption application? So the IRS does require that an organization makes its tax return and exemption available for public inspection. And there's a whole section about how many days you have and when you have to respond. But it's generally, if someone is requesting in person, the foundation is required to provide a copy of those documents on the same day, unless there's an unusual circumstance or it would be an unreasonable burden to the foundation to provide it that same day within their business hours. Then the organization would have to provide it either the next day or within the 5th business day after the date of the request. If the request was through a written request, then the foundation would have to respond and mail it within 30 days from the date that the private foundation receives this request. The private foundation can charge a reasonable copy fee as long as it's not more than what the IRS charges per page copy fee. And they usually issue that in the private foundation or in the instructions as to what the per page copy fee is too. So just wanted to call that out that, you typically do want to answer yes to this question and make your documents publicly available because the IRS does require it, and there are certain steps and procedures that the organization will need to do here. All right, let's talk about this part, and these are really statements regarding when activities might trigger a Form 4720 filing requirement. The Form 4720 is really an excise tax form that deals with different types of activities that an organization might make themselves or their disqualified persons or managers subject to this excise tax. Some of the excise taxes are self-dealing, excess business holdings related, jeopardizing investments, and taxable expenditures. So the comment I made earlier with regards to the 508E in the governing documents prohibiting the organization to participate in those types of expenditures, then that's when you might have this tax. There are some exceptions to this, so you would indicate in the form that you met the exception, and there's a little checkbox in there too. And this particular one, during the year, did the foundation either directly or indirectly engage in these activities? So sale or exchange, leasing of property with a disqualified person, borrow money from, lend money to, or otherwise extend credit to except from a disqualified person, furnish goods, services, or facilities from a disqualified person, or pay compensation to, or pay or reimburse the expenses of a disqualified person. So these questions in particular deal with self-dealing type questions. And if you answer yes to these, it may or may not be okay based upon if you do meet the exception to it. So just wanted to highlight that, and we'll cover self-dealing and walk through some examples in a little bit. Okay. So this particular question, question 3, deals with business enterprises and whether an organization has excess business holdings. And so answering yes or no depends on kind of on the answer after that, you might be required to file either Form 47C or attach a little bit more explanation here. So just calling that out. And then with that, we'll kind of go back to self-dealing examples and what we commonly see with our clients and prospects as to, okay, is this okay? Is this okay? Can we do this types of activities or not? So I'll just briefly walk through these self-dealing examples. In this case, the disqualified person sells property to a private foundation at or below fair market value. The IRS generally views that as a no-go, and that would be considered self-dealing. The disqualified person donates property to a private foundation. That's okay. That's typical activity. You would expect, stock donations or property donations to the private foundation, normal, typical activity. The disqualified person donates property to a private foundation subject to a mortgage, generally is a no-go. The disqualified person rents office space to a private foundation at or below fair market value, also a no-go. The disqualified person donates office space to a private foundation, that's okay. So this really is just, let's say, disqualified person owns a building and they have the private foundation housed in that building as well. They don't charge them any rent. That's okay. The next one is disqualified person makes a loan to a private foundation at or below market terms. That's, again, a no-go. And then disqualified person makes a no interest, no fee loan to the private foundation. That is likely okay. We do have a little, caveat there with a little asterisk, which really means that the disqualified person, however, may be subject to the imputed interest rule. So the IRS kind of has conflicting laws and regulations where they technically always, in general, require that you charge interest if it is a true loan. So kind of the caveat there is to, talk with your tax advisor and see if that is a situation that could work here in your case. And then this one I see a lot, and I get a lot of questions on this one, is if the private foundation receives tickets to a fundraising event and the disqualified person board members attend as representatives of the private foundation. That is okay. Where things get a little sticky, however, is if the private foundation receives these tickets, but the disqualified person's family attends the event and not the board members. That's really when is it really, are they representatives of the private foundation? Most likely no. That's when people can get themselves into a situation. Now, also if the board members do attend and let's say there's an auction and the board members use their organization's funds to purchase an auction item that could benefit the private foundation in its exempt purpose, that is likely okay. But be cautious about that. If the funds are being used for something that would have a personal use or impact, that may trigger a self-dealing type situation too. So if they are auctions, be cautious and kind of make your board members aware that, hey, let's make sure that it does meet our exempt purpose and that we are using the organization's funds properly that meet our exempt purpose rather than a personal use item. So just a word of caution there. Okay. Just a few more examples. The private foundation makes a grant to a public charity at the direction of disqualified persons on the board within the private foundation's exempt purpose. That's okay. The private foundation makes a grant to a public charity to fulfill a pledge by a disqualified person is usually not okay because that pledge was made by the disqualified person individually, so that's a self-dealing type transaction. So do watch out for that. Make sure that the pledges are signed by the foundation and are actually pledges by the foundation, not the individual person. Private foundation makes a grant to a public charity at the direction of disqualified persons on the board, and their children or family members benefit from the services the charity provides. So a benefit provided to the general public as well within the private foundation's exempt purpose. Any which conflict, if there is a conflict with the disqualified person, that person would recuse themselves from the vote, make sure that it is an independent vote. that's usually okay. To make sure that this is documented in minutes, for example, that the person recused themselves and that they do meet the qualification. Private foundation makes a grant to a public charity, earmarking the funds for the benefit of disqualified persons, children, or family members within the private foundation's exempt purpose is usually not okay. So earmarking the funds to go and benefit the disqualified person is considered a self-dealing type transaction. And then private foundations giving a gift to a disqualified person, such as flowers or token gifts upon retirement with a value of $25 or less is usually okay too. And then lastly, the private foundation gives a gift of cash to a disqualified person that wasn't included as taxable income or was more than the value of services provided to the foundation is usually not okay. So you can see there's a few gray areas that require a little bit more digging and a little bit more understanding as to, okay, what is the value? How do you determine the value of these things? And what's your documentation? Because the IRS really requires that these organizations document that. Just a few more examples here. A transaction between a private foundation and a disqualified person, and the disqualified person's status arises only from those transactions. So the transaction causes the person to become a substantial contributor, such as discount purchases, then the self-dealing rules wouldn't apply in this case. Or a transaction with a former disqualified person here. So if a board member leaves the board, then enters into a transaction with the private foundation, that's not self-dealing because that individual is no longer part of the board. And then providing the following if the value isn't excessive and are reasonable and necessary to carry on the exempt purpose for goods, services, facilities that are provided to the foundation manager or volunteer, or compensation for personal professional services. So in this case here, it's really board members can be paid for their services on the board, and they can have expenses reimbursed so long as they're reasonable, so not excessive, nothing too crazy. In some cases, when there's a trust or bank of the trustee, then general banking services are allowed for like checking, saving, safekeeping type activities. And then permissible personal services include services for management activities, real estate investments, or professional managerial types in nature. Those are okay too. So with that, I think we have our next polling question. Back to you, Amy.
All right, thank you. So our second polling question is, if you pay your CEO or executive director reasonable compensation for services provided to the foundation, should Part 6B, line 1A4 be answered yes? We have yes, no, or yes, but an exception applies. And then as a reminder, if you would like to receive CPE credit for today's webcast, you will need to respond to at least 3 of the 4 polling questions. All right, here are the results.
All right, you pay your CEO, executive for reasonable compensation. Yes, but an exception usually does apply, but you definitely want to document the reasonable compensation component, document why it is reasonable, and most likely an exception could apply. I think with that, I'm going to turn it over to Colleen to walk us through the rest of the Form 990. Yes.
Thanks, Emina. Hello, everyone. Thanks for joining us today. So I'm going to continue on with Part 6B, which is additional activities that could require 4720 to be filed. 5A, these activities generally could lead to taxable expenditures. Taxable expenditures do have a 20% initial excise tax on it and a potential 5% initial excise tax to any manager who knowingly made the taxable expenditure. So 1 and 2 of 5A relate to lobbying and political activities. All 501c3 organizations, which include private foundations, are prohibited from doing any political activities. And private foundations are prohibited from doing any lobbying activities as well. Line 3, providing any grants to an individual for travel, study, or other similar purposes. This can be allowed, but the private foundation does need to get pre-approval from the IRS. This, for example, would be if scholarships are given. The approval from the IRS can be obtained either through the exemption application. There is a section that can be attached that includes the information the IRS is looking for. If it is done or if it needs to be requested after that point, there is a form that can be filed where essentially the same information is provided to the IRS. Line 4, if grants are given to any organizations other than charitable, so we're looking at non-charitable organizations, for-profit, certain supporting organizations, other private foundations. Grants to these organizations can potentially be okay if expenditure responsibility is done, and we'll get into that in just a little bit. And then line 5, if it's given for anything besides a charitable purpose, that could potentially also be a taxable expenditure. There is a question on 5B that says, did any of the transactions fail to qualify under the exception? So this is kind of, usually you want to say, yes, it qualifies for an exception. But if it qualifies for an exception, because there's an exception to almost everything, you would answer no here. If you answer yes, then you are likely the foundation likely needs to file a 4720. On 5D, it does ask if you gave a grant to a non-charitable organization, then did the foundation maintain expenditure responsibility? Then next on line 8, this asks question regarding Section 4960, which is an excise tax on remuneration paid of over $1 million. This was passed with the Tax Cuts and Jobs Act back in 2017. So at this point, it's been around for a while, but as far as some of the other activities that could have excise taxes on it, it's fairly newer. And I will touch on that a little bit later in the presentation. So the next part we have is part 7, where we are listing certain numbers, and then we're also providing compensation information. On line 1, we are providing board and officer listing, also trustees. These persons get listed even if no compensation is provided. And then on line 2, the top highest compensated employees who are paid over $50,000 and not listed on line 1 are reported here. If there's only 1 or 2, then it would just be those 1 or 2 that are reported here. Something I do like to point out here, they do require an address be provided with the name of the individual. This is a public document, so I do usually advise foundations to be mindful if any personal addresses are being used. More often than not, we see the foundation address being used. Just again, it is a public document. This information's out there for anybody to kind of get their hands on. So just something to keep in mind. So in column B, we're reporting title and average hours per week for the position. If there's compensation being paid, we do want to make sure that the hours are reflective of that compensation for reasonableness. So if they're paid quite a bit, you want to make sure that their hours are reflecting, they've got 40 or 50 hours per week that they're devoting to their position, so they can, it shows the picture of this higher compensation is reasonable for the hours that they're working. Column C, we've got compensation, which is generally the taxable compensation. Column D, you include any employment benefit plan payment, any deferred compensation. The deferred compensation does include compensation that was earned in the prior year and is not paid by the time of the return filing. And then finally, in column E, enter both taxable and non-taxable fringe benefits, expense account, and other allowances, including any personal use of housing, vehicles, or other assets of the foundation. With that use, again, be mindful of the self-dealing restrictions. So the third part, line 3 of part 7, is the five highest paid independent contractors. These are contractors paid over $50,000 who perform personal services of a professional nature. So you're looking at consultants, accountants, lawyers that would be listed here. It does include corporate vendors who would not receive a 1099. So 1099 information could be used here, but foundations do want to make sure that they are also picking up corporate vendors. So next, we're going to get into the popular 5% distributable amount that all private non-operating foundations are required to do. Part 9 is the calculation of the minimum investment return, which is essentially the base starting point of for the distributable amount for the year. Line 1A, average fair market value of securities. Line 1B, average monthly cash balances. Those are fairly straightforward. Then line 1C is fair market value of all other assets, and that would include assets other than charitable use, publicly traded securities, cash, and certain excluded assets. The most common that we see here are real estate and some alternative partnership investments. These can be valued annually at one point in time, so it's not an average over the year. A foundation can pick the date. You could pick the beginning of the year, it could pick the end of the year, middle of the year. That date just must still be used going forward every year. There's also an adjustment if the asset's held for less than a full year. Also, for real estate, a valuation of 5-year or a valuation can be used for 5 years if a qualified appraisal is obtained. So versus having to value it every single year, you would do an appraisal in year 1, and then you can use that going forward for 5 years and not, even if the value of that real estate has gone up, which generally is what we see, you can still use that year 1 valuation. And so that could be helpful with kind of planning out for, what the distributable amount would be. Line 2, acquisition indebtedness that's applicable to any of the assets that are on line 1 can reduce in the calculation for minimum investment return. And the definition for acquisition indebtedness is the same as it is for unrelated debt financed income, which comes into play for unrelated business income. Line 4, cash deemed held for charitable activities. The IRS allows a reasonable cash balance to cover current administrative expenses and other normal and current disbursements directly connected to charitable activities to be pulled out of the minimum investment return calculation. The IRS has deemed that 1.5% of the value of assets is reasonable. However, if the foundation has facts and circumstances that support a larger amount, it can, but it must attach an explanation supporting that. So finally then, we get to the minimum investment return, and that's the 5% of the net value of non-charitable use assets. So in general, you hear kind of people say, oh, the distributions have to be 5% of assets. Yes, but there is a bit, as you can see, that goes into the calculation of what that 5% is taken of. So next we get into part 10, and this is where the calculation of the actual distributable amount for the tax year is. Again, it starts with minimum investment return. There's a reduction for any taxes paid, for any net investment excise tax paid, and for any unrelated business income excise tax or tax paid. This doesn't include excise taxes that were paid on the 4720. Then there's an increase if there's a recovery of any amount that's been previously treated as a qualifying distribution. So this would be any program-related investment repayments or a sale of charitable use assets. And the reason for that we will see in Part 11, where the calculation of the qualifying distribution, so the distributions that you use to meet that distributable amount. So the first thing goes into that is the disbursements for charitable purposes, which Emina went over on page 1, Part 1, column D, which that is on a cash basis. And then any program, any cash or funds distributed for program-related investments, and then any amounts paid to acquire assets for carrying out charitable activities. So you get credit for those in figuring your qualifying distributions, but then when you essentially kind of get the cash back or part of that cash back, then you have to add it back to the distributable amount in future years. All right, next section is Part 12, and this is where we're determining if the qualifying distributions are meeting and covering the distributable amount. This page can get kind of technical and complex, but just going to kind of go over high level some items. Any current year qualifying distributions first go towards any prior year undistributed income. Undistributed income is essentially any of that distributable amount that hasn't been met by qualifying distributions by the end of the year. And then any qualifying distributions in excess of the distributable amount, it can be carried forward for 5 years and used against future year distributable amounts. So you'll see on here, if you had excess qualifying distributions from 2017, it gets carried forward all the way to 2022. So you could use it against 2022. If you didn't, then it rolls off. If there is not enough qualifying distributions to cover current year distributable amount, it carries forward to the next year as undistributed income and must be distributed by the end of that next year. Now that's for current year distributable amount. So 22, if there's undistributed income, that needs to be covered by the end of the 23 tax year. If you still had a carryover from 21, then you're potentially looking at excise tax on undistributed income, because that 21 undistributed income that carried forward to 22 would need to have been met by qualifying distributions by the end of 22. With that, we're going to move on to what I believe is our third polling question. Amy?
Yes, so the third question is a true or false. Undistributed income carries over for 10 years. Just select true or false and hit submit. And then while you're responding to that, for those of you that would like a copy of today's slides, you can download them now from the folder that says slide deck and handouts. And then we're also sending them via email tomorrow along with a recording of this webcast. All right, this one's going pretty quickly. We'll give it another few seconds here. Here you go.
Great. So most of you said false, and yes, that is correct. I suppose you could carry it forward for 10 years, but then there's going to be quite a bit of excise tax paid, and will probably catch the attention of the IRS. So generally, undistributed income, you want to make sure you're covering with qualified distributions by the end of the following tax year. Next, we're going to touch on Part 14, just some information here. On line 1, A and B, it's asking some information about foundation managers, such as directors, trustees, and officers. Line 1A is asking for any managers that are substantial contributors. Those need to be disclosed in an attached explanation. We often see foundation founders listed as substantial contributors. And a substantial contributor is a donor who contributes more than 2% of all contributions received over the lifetime of the foundation as of the end of the tax year that the reporting is for. Then line 1B lists any managers who own 10% or more of an entity, which the foundation also has a 10% or greater interest. And this could potentially point to excess business holdings. However, there are, like I said earlier, there are exceptions to everything. So reporting here doesn't necessarily mean that you have an issue with excess business holdings. And then next we have line 3, which is grants and contributions paid during the year or that are approved for future payments. 3A are grants paid. 3B are grants approved for future payment. 3A grants paid are what would be going into your qualifying distributions. Ones that are approved for future payments, those will go into the qualifying distributions once they are paid, again, because that calculated number is on a cash basis. If a recipient is an individual and there's any relationship to a foundation manager, that needs to be noted on this section. Also then, status of the recipient needs to be noted. There's different codes for the different types of entities. So public charities, PC, PF for private foundation, GOV for government, I for individual, and then NC for kind of all others. So that's including your non-501c3 tax exempt organizations, any for-profit organizations. I do like to mention here, because there's certain like supporting organizations that could require expenditure responsibility be done, it is important when foundations are checking for the public charity status. So if you're going on GuideStar, if you're going on the IRS's tax exempt organization search website, it may not be enough just to pull up the return and look and see that 501c3 is marked on that first page. It's good practice to go to the Schedule A and verify what type of public charity it is. If you do see that the organization's filed a 990N, rest assured it is not a supporting organization, because supporting organizations cannot file a 990N. So as I mentioned, contributions to certain organizations are allowed by private foundations. Certain are not allowed unless there is unless expenditure responsibility is done. So first I'm going to go over who that applies to as far as grant recipients, then what the steps are, and then the potential consequences of not doing expenditure responsibility. So you'll see here we have a nice list on the left of all of these organizations. You don't need to do expenditure responsibility. Private foundations are able to just give to the organizations. Public charities, U.S. and foreign governments, exempt operating foundations. This isn't necessarily all private operating foundations, so it's important to look at that. And then executive order organizations. And then over here on the right, we have organizations, which I've kind of touched on before, that expenditure responsibility does need to be done. One that may not always be thought of would be newly formed public charities who haven't received their IRS determination letter. And that's because just in case the IRS denies the exemption, then you don't kind of have that retroactive application of exemption back to the date. So then essentially, the foundation has given to a for-profit organization. So doing that ahead of time kind of covers the foundation in case the exemption is not obtained. What is expenditure responsibility? It's essentially making all reasonable efforts and establishing adequate procedures to meet the following: to see that the expenditure is spent solely for the purposes for which it was made. This includes doing a pre-grant inquiry and then also having a grant agreement in place. This seems like a pretty simple step. There's actually a lot involved and that needs to be involved in this step. And then the next is obtaining full and complete reports from the recipient on how funds are spent. This is generally on an annual basis if the grants are over a couple-year period. And generally, we see these being given within a certain time after the recipient's tax year end. And then full and complete reports need to be disclosed with the Form 990-PF. This is a disclosure where it asks certain information. The support documentation that's obtained from the recipient does not need to be attached to the return, just certain information needs to be included. Consequences of not doing expenditure responsibility. I spoke ahead of time earlier of if you don't do ER, then it can be a taxable expenditure. The first tier tax on that is 20% on foundations, 5% on knowing managers. There is a potential secondary tax if the expenditure isn't corrected. There's potential abatement that could be allowed of that first tier tax if it can be shown the expenditure was made for a reasonable cause and there wasn't any willful neglect and the expenditure was corrected. I'm just going to touch quickly on excise tax summary. So this is kind of a nice summary of the different activities that private foundations are not allowed to do. Again, there's exceptions to all of these. So it has who the tax is imposed on, the initial tax, and then the additional tax that could be assessed. Generally, further taxes such as the second tier tax are applied after a correctable tax event within the correction period, and the correction period is, if it's after the correction period. The correction period is the day the after investment happened and ends 90 days after notice of deficiency received in connection with the second tier tax that was imposed. Just trying to go quickly through some of these so we have time for everything. Like I mentioned, there's a 21% excise tax on remuneration in excess of $1 million. I don't generally see compensation of $1 million being given to employees or foundation managers of foundations. It's important. What's important to think of with private foundations here is that all related organizations must be aggregated. So if you have a for-profit related organization and a private foundation, you have to look at them together. And so where that could come into play is if one of the persons is compensated over $1 million on the for-profit, that could potentially trigger that person to be what's called a covered employee. And with a covered employee, they're could be subject to this excise tax. There is an exception. So there's a limited hours exception. So if less than 10% of the person's time to all of the organizations is to the exempt organization, or if they work less than 100 hours for the year for the exempt organization, then they are accepted from being considered a covered employee. It's important to note, though, once somebody is a covered employee, they are always a covered employee. So as soon as this exception doesn't apply, you can't apply it in future years because that person's become a covered employee. Some quick tax updates. Pretty much all tax-exempt organization forms are now required to be e-filed. Not listed here, but included is Form 4720 as well. There is, as Emina had mentioned earlier in the presentation, there is some legislation that's out there. It was introduced in the Senate in June 21, then again in the House in February 22. It's the Accelerating Charitable Efforts Act, or the ACE Act. It has not gone anywhere besides being introduced. It is also, though, some aspects are included in the U.S. Department of Treasury Green Book, which is not legislation, but it's kind of a roadmap to how the administration, what they want to do in the coming year. I'm not going to get into this slide too much. It mainly has to do with changes, restrictions, requirements for donor-advised funds. But as Amy mentioned, you can get a copy of these slides, so you'll have access to this information. What I want to touch on is this slide that kind of has more of the effects to private foundations. You'll see in the bottom left-hand corner, right now, private foundations can give grants to donor-advised funds and have them be a qualifying distribution. Under this legislation, distributions would not be qualifying distributions unless the donor-advised fund made a qualifying distribution in the same year. So it essentially needs to be an in to the donor-advised fund and an out in the same taxable year in order for the private foundation to take it as a qualifying distribution. And the burden is on the private foundation to support that. Also, administrative expenses paid to disqualified persons of a private foundation would not count as a qualifying distribution. This would exclude payments to foundation managers who aren't related to other disqualified persons. This doesn't change any of the self-dealing rules. It just affects what can and can't be taken as a qualifying distribution. And then finally, there would be a way to have the 1.39% excise tax on net investment income waived, and that would be if the qualifying distributions were 7% of that distributable, or 7% versus the 5% minimum investment return that's calculated, or if the private foundation is a limited duration foundation, which essentially means it's not going to have a duration over 25 years, and it's not going to make distributions to other private foundations that share disqualified persons, except for other limited duration private foundations. And with that, I'm going to pass it over to Jennifer.
Thank you, Colleen. So our outsourced finance and accounting group, which I'm a part of, works closely with Colleen, Emina, and our tax teams during tax planning and preparation time to get them the information they need for our mutual clients. And so I'm just going to touch on a few things here that we've seen and sort of best practices based on our experiences we've had with sort of handling the accounting for our clients. Next slide. So from an accounting perspective related to the tax return information gathering and planning process, one important thing to keep in mind when you're starting out, or maybe even not starting out, but are looking to do a revamp, is the development of your accounting and reporting structure and how that can accommodate or mesh, if you will, with information needed for tax planning and tax return preparation. So, really dedicating that time up front and being thoughtful around the various accounts you'll use, if you're going to use any department or class tracking, et cetera, will really help make things easier down the road. Now, that being said, while it is important and a priority definitely for that chart of accounts to be effective for internal management purposes, several of those accounts might already serve a dual purpose, right, and help with the tax information gathering. But there might be others that you may want to consider or at least have a reasonable understanding of, so that, when the time comes to pull that information for tax planning or tax return preparation, it's easy to do so. So overall, really just making that effort to streamline your accounting and reporting structure up front will assist in making that year-end tax planning process and preparation of returns much more effective and efficient for both you and your tax professional. So taking that last slide one step further, here are some considerations for the chart of accounts, or what is also referred to as the natural classifications, that you may want to consider. As I'm sure you saw, in the earlier slides that Colleen and Emina went over, the accounts listed here tie nicely to the information that your tax preparer will need for the tax return. But again, like mentioned before, these are also likely things you might have already considered tracking on your books for internal management purposes, which is great. So just to touch on a few, we have contributions, gifts, grants received and paid, investment income and related expenses, any professional fees. The form does split out legal from accounting in that area. And then there's also salary expense. So we saw earlier, sort of adding another layer to that, you'll want to be able to pull the information for your 5 highest paid employees for the tax return. Now, that doesn't mean you have to necessarily track that within the accounting system, but again, being able to pull out that piece is needed. So, for example, if you're maybe using a third-party payroll service provider, you can usually get that type of detail or breakdown from the payroll reports that they generate for you. And then contractors is another piece too, similar thing there. You want to be able to know the 5 highest paid, and that can typically be done by just running a vendor report in your accounting system. So I will pass it over to Mike, who is going to talk about streamlining the accounting and reporting structure from more of a dimension tracking perspective.
Thanks, Jen. In addition to your chart of accounts, many accounting software applications allow custom report building and dimension setup. As many of you know, the information request for your filing will typically ask for data presented in a manner that can create a time-consuming and frustrating project. However, if you configure your system and build the necessary reports, it can save a lot of time on the back end. Of course, this usually means that transactions must be coded correctly when initially entering data, but a little time on the front end can save a lot of time on the back end. For example, most accounting software applications have a dimension set. QuickBooks usually calls these classes, Intact or NetSuite calls them actually dimensions, and these are set up for departments, which when thoughtfully structured, present revenue and expense grouped together in the following sections: administration, investments, and then program-related transactions. Next slide. Of course, customizing your accounting software can seem like a daunting prospect if you aren't an experienced user or already know how to do it, but there are resources available. First, the accounting system itself usually will have a help or knowledge center, and there are a lot of times quick start templates that help with initial not-for-profit chart of accounts and reporting packages. These packages will allow you to get off to a running start instead of building the system from the ground up. Obviously, you can always talk to your tax accountant, and they are usually available to give feedback about what they need and how they need it. And finally, an outsourced accounting partner can also help with this. Many outsourced accounting firms have people that are very adept at working with accounting systems, and they could probably help you as well. And I think we're finally on to our next polling question.
Yes, thank you. So the last polling question is, what private foundation topics or areas do you believe you need more information or advice on for the future? Self-dealing, taxable expenditures, excess business holdings, unrelated business income, alternative investments, or other. And once you've completed all CPE requirements, you will be able to download a PDF of your certificate from the CPE progress window. Give it a few more seconds here before we start wrapping up. All right.
Great, thank you. So about even on some of the more topics that we'd like to cover, so thank you for that. That gives us great ideas for our next webinar. So really appreciate everyone joining us in today, listening to us present on the Form 990-PS and some of the hot topics. If you do have any questions, please post them into our Q&A. We'll try to address them as soon as we can after this webinar. So if you have questions, please post them. With that in mind, we do want to mention, save the date. We have our 2023 Private Foundation Virtual Conference scheduled for September 19th and 20th. There should be a link within your console to get registered. So Some topics that we'll cover is sport governance, legislative updates, outsourcing, the Form 990PF in greater detail, and some other hot topics out there. So with that in mind, we do have quite a bit of resources available and insights. So check our website out with the links provided and connect with us, subscribe to our Moss Adams content, and reach out to either one of us or your tax preparer. With that, back to Amy to close this up.
All right, thank you. And thanks you to all of you for a really great presentation today. And to our audience, feel free to reach out to our presenters if you have additional questions. And you can also let us know if you want to set up a separate call to discuss this more in depth by dropping a note in the Q&A window. And if you met all CPE requirements, your certificate is available to download now in the CPE progress window. A copy will be emailed within 2 weeks if you have difficulty downloading it now. And finally, here's a link to an online survey for today's presentation. And thank you for joining us. Take care, everyone.